Guys, Charles Schwab has just announced a 3-to-1 stock split for its ETF, a whole host of its ETFs. One of the most important ones that they're splitting is SCHD. And I just pulled up SCHD for us to look at. This is going to be a fairly quick video. I just want to share why perhaps they're doing some of these splits for their ETFs, but also what this is going to mean for you as an investor. Okay. As you can see, guys, today, as we speak, the SCHD is trading about $83.74 per share of this ETF. Now, remember, an ETF is just a bucket full of stocks. Okay. And that's all it is. Guys, the reason I wanted to highlight SCHD is because it's one of the more popular ETFs that Charles Schwab offers. And just so you know, Charles Schwab is splitting the shares of 2/3 of all of its ETFs, right? They're trying to stimulate some type of sales with lower share prices on their ETFs, right? So when I look at the chart over here, guys, in terms of the other ETFs that they're actually doing splits on, you got SCHG, right, which is the US large cap growth ETF for Charles Schwab. You've also got their mid cap. SCHM is doing a 3-for-1 split. And you got some other real popular ones doing a split, right? SCHB is doing a split. SCHJ is doing a split. So a lot of Charles Schwab ETFs are doing either 2-for-1 splits, 3-for-1 splits, and there's just a couple of them or one or two of them doing 4-for-1 splits. But SCHD is doing a 3-for-1 split. Right now, some of the holdings in the bucket called SCHD, you got Lockheed Martin, you got AbbVie, BlackRock is in there, Coca-Cola, Home Depot, Cisco. These are some very, very stable companies. Now, let me look at a quick article with you guys real quick. Schwab Assessment Management, the arm of the Charles Schwab Corporation, today announced forward share splits of 20 Schwab ETFs. Forward ETF share splits increase the number of shares outstanding and decrease the net asset value per share. The share splits will not change the total value of a shareholder's investment, right? So if they're doing a 3-for-1 split and you own 10 shares, now all of a sudden you're going to have 30 shares roughly, right? So that's all that means. It's just going to lower the price per share and you're going to have 30 shares now, but it's not going to change the amount that you have invested. And it goes on here to give you a list of some of the ones here that I mentioned that are actually doing those splits. Now, just so we're clear, guys, SCHD is Schwab's dividend equity ETF. It's an exchange traded fund that its whole aim is to track the performance of the Dow Jones US Dividend 100 Index. Okay. Now, this index focuses on really high quality US companies, as you could tell by what I just read. And these companies have a history of consistently paying good, solid dividends to its shareholders. Right. So SCHD invests in companies that really have a solid track record of paying these dividends out to their shareholders. Usually these are large companies, and some of the top holdings, as I mentioned, was Coca-Cola, Home Depot, Verizon, PepsiCo. All these are stable companies with stable earnings. What I like to call more value type companies that are in the ETF called SCHD. And SCHD, again, it's mirroring that Dow Jones Dividend 100, which is following those companies with these good, solid returns. And also, not to mention, SCHD has a really low expense ratio. What that means is that it's cheap to own. It doesn't cost a lot. Your expense for owning SCHD is pretty attractive, very low, right? Making it a very cost-effective type of ETF for investors. And SCHD is one of those ETFs that I always recommend for new investors, people that are just getting started with investing and may not want to take a lot of risk or may not want to actually learn everything they need to learn to invest in individual stocks. SCHD is one of them that I always recommend to new investors because you're going to get dividend income that you can reinvest back into the stock or back into the ETF. And of course, there's some capital appreciation with these steady, long-term, solid companies. And you also have the option of getting cash from these companies as well, getting cash from your ETF called SCHD. So if you're a new long-term investor, SCHD is one of the most popular ETFs that are out there because it's focused on income and it's with the dividends, right? And it's also focused on stability and it also has a low expense ratio, right? So people that are new, maybe closer to retirement, but still want to get a little bit of growth, but at the same time be getting that dividend, it's a great place to be. SCHD is. Not to mention that dividend that I talked about that it normally gives is usually a little higher yield dividend. than the average dividend, right? Compared to, usually broader market type ETFs, SCHD offers a fairly higher yield than a lot of those. Not to mention diversification. Obviously, SCHD is spread across various sectors, guys. And that always reduces your risk, right? The more spread out into various different sectors an ETF is, like SCHD, less risk for you. Again, making it a nice choice, a good choice for somebody that's new, somebody that wants something steady and doesn't like a lot of volatility. So that's some reasons that SCHD is really popular. So this 3-to-1 split is pretty interesting, but it's nothing to be really alarmed about, right? It doesn't change the amount of holdings that you have. So there's no need to think that it's going to be good, bad, ugly. It just is what it is, right? Charles Schwab has said we're going to do a 2-to-1 to 3-to-1 or 4-to-1 split on a number of our ETFs. Charles Schwab has come out and said they want to make their shares a little more accessible to a broader range of investors, even though many of their shares, like SCHD, is not very expensive right now. But if they make them a little bit cheaper, they feel like they make them more accessible to more people in terms of investing. They want to make them more affordable. And if they split the share from $90 per share to $30 per share with a 3-to-1 split, it makes it more attractive to retail investors like me and you, right? Regular retail investors are more apt to buy a share when it's $30 per share than they want to buy a share when it's $90 per share. So it helps us smaller investors, us smaller retail investors, get into the fund without needing a large amount of capital, a lot of money to get into it. You see some, like Vanguard has some funds like VOO that's like over $500 per share, or VGT. And when it gets to that level, guys, a lot of regular investors won't be investing. Not to mention, for Charles Schwab, SCHD, this lower share price could increase some of the trading activity that happens with this ETF as well. The split doesn't change the value of the ETF. What you hold is what you hold, whether you hold 30 shares or 90 shares, the amount of those shares still is the same. Now, look, if you don't invest in ETFs, or you don't invest in, say, dividend ETFs like SCHD, and you're considering it, let me just give you some pros and cons to think about. Some benefits of a regular dividend ETF like SCHD, or like a VYM if you're over on Vanguard. But let's stay with SCHD. Dividend ETFs provide you with sort of steady income because of those dividends, if you choose to keep the income. Or you may choose to reinvest the dividends right back into the fund. That's cool too, right? Again, lower expense ratios always help. Also, lower risk. Dividend ETFs typically are a little bit lower risk when you talk about these value type companies that are in the basket, in the bucket called SCHD, right? A dividend type of ETF. And so that's why you get your Coca-Colas and your Home Depots. These places aren't going out of business anytime soon. And they have a long history of providing good, solid dividends, right? So again, I'll mention some of the other dividend ETFs that are out there. VIG at Vanguard, VYM at Vanguard. The iShares has I think it's DVY, and Schwab has its SCHD. But any of those dividend type ETFs that are investing in value companies, those are solid places to have your money, especially if you're a long-term investor. But dividend ETFs can really be an effective way for a regular retail investor to gain exposure to stocks in the bucket that pay dividends, whether it's income or value or whether it's growth. The diversification are nice, and the payouts in terms of dividends are even nicer. Now, me personally, guys, I like to reinvest dividends back into the ETF. So I own a bunch of VYM and I reinvest back into it. And if you own a bunch of SCHD, even with this stock split, you still want to consider reinvesting that dividend back into the ETF itself, right? So, hey, I just wanted to give you this quick breakdown, what this stock split of SCHD or any of the other ETFs that Charles Schwab is offering. They're doing major splits on 2/3 of all of their ETFs. Hey, listen, if you got any value at all out of this really quick video, do me a quick favor, smash that like button and let me know in the comments below if you own SCHD, and are you looking forward to the stock split, or does it really not matter to you one way or the other? Let me know in the comments below, guys. Hey, listen, the best person who's going to take care of the old you is the young you. Guys, do me a big favor. Take care of yourself. and take care of other people. Until the next video, peace.